Your daily live updates. Get the most out of today's episode by participating in the chat. Make sure you ask some questions, be part of the conversation, have a bit of fun, grab a coffee or a tea, take some notes, and get ready to start your day, folks. Quick few housekeeping rules, though. No spamming, no advertising or self-promotion in the chat. That's not on. Be kind and respectful to everyone when participating. And most of all, have a good time. Real estate investing can be your biggest asset. It also can be your most expensive asset when it comes to getting it right or getting it wrong, folks. It can be time-consuming, stressful, and that's why here at Positive, we have what's called a 6-star team, a full-service team that provides integrated wealth and property investing solutions and services simply designed to help you progress towards your goal of passive income through your property portfolio, folks. Make sure you check out our other podcasts on the Positive Mentor Network. Not only is there Wealth Coffee Chats, there's the Urban Property Investor. Drops every Wednesday with straight talking investing strategies and lessons with Sam Saggers. Property Investor Tales. This is where our clients, you guys, share real life stories from property investing, hosted by some of our advisors and strategists. And that's done every fortnight, dropping every Monday. Wealth, Wine and Wisdom, folks, that debriefs the week that was in the world of finance and property, hosted by yours truly, Jason Witten and Andy Fenton on Fridays. Hey, good morning, folks.
Good morning, everybody. Welcome to another Wealth Coffee Chat.
Hope you're well, folks, wherever you are.
There it is, team. Morning. Morning, wherever you're tuning in from today.
Early bird gets the worm, they say. Here at Positive, we offer a 6-star team. It's a team that help you at every stage of your wealth creation journey.
General advice disclaimer. The information provided is general in nature and does not take into account your personal objectives, financial situation, or needs. Before acting on any information, you should consider whether it is appropriate for your circumstances and seek professional advice from a licensed financial advisor. While every effort has been made to ensure the accuracy of the information, it is not guaranteed. It is based on our understanding of regulations and laws as at the publication date. As these are subject to change, you should talk to a professional advisor for the most up-to-date information. Any examples or illustrations provided are for illustrative purposes only and are not a guarantee of future performance. We do not accept any liability for any loss or damage incurred by reliance on the information provided. Any opinions expressed are subject to change without notice. Past performance is not indicative of future results, and all investments carry risks. Neither the hosts, guests, nor any affiliated entities accept liability for any loss or damage arising from reliance on the information provided. By listening to this podcast and viewing this presentation, you acknowledge and agree to these terms.
Morning, everyone. Welcome to another Wealth Coffee Chats with myself, Alex, from the financial planning team. I'm not sure if the video is coming through the same as it is on my end, but it looks like it's a little bit funny on my end. All right, that looks a little bit better. Thanks, Ethan. Morning, everyone. Love my coffee over the last week with the frost and everything that we get here in Melbourne. So hopefully we're almost there and looking down the path of spring in the next couple of days. Morning, Pat. Good to see you. Good to see you, mate. Say hello to Anthea for me as well. All right, guys, look, let's dive into it. And by the way, just on last week, we are doing a couple of little updates in the background. So, hopefully things will iron out over the next few weeks and we'll continue to bring the content to you. So, last week, I actually had something prepared. I was so excited for it because I saw that the rest of the gang didn't actually do their videos. I'm going to break the news. The interest rates are down, and then, a week later, it's now old news. However, right, what I want to do today is kind of show you how you can look at the statements from the RBA and what to look out for in what they sort of deliver to you, which is typically second week or second week of each month. On the Tuesday, 2:30 p.m., you get a statement from the RBA about the rate decisions. It's not every month now. It's they've changed the timing of it, but ultimately they release a statement to illustrate reasons for their decision on whether they want to keep the rates where they are, reduce them, or take them up a notch. So I think for you guys as an audience, I think it's an important piece to consider when you're making decisions, right? Because ultimately, it carries a lot of information as to where the interest rates are, especially if you in property investing, and interest rates is a big component to financing or your cash flow and whatnot. I think it's important to be across this. And, typically it takes a couple of minutes to read through. And, there's certain things that are in there that, a little bit of fluff, but there's also some really good indicators as to where things are traveling. So, Ethan, if you could just share the main screen a little bit bigger. I'll just I've highlighted a few things from the statement that was released last week. So obviously everyone knows we had a 25 basis point cut rate, not 25%. That would have been that would have been crazy, but also good. And I don't know if you hold property, you would have been in the skies, I would say. But look, if we look through the statement, what are they saying? They reduced the cash rate by 25 basis points, so now it's down to 3.6. So they make that decision on the back of the inflation now falling, which is one of the main targets for the RBA, and they sort of take credit for that on the back of the high interest rates that they held there for sort of 16 to 18 months before they started looking at reducing it further. So, if we look further, we've got underlying inflation will continue to moderate to around the midpoint of 2 to 3%, which is the target, right? So the target rate for the RBA is to keep inflation at 2 to 3%. There's a lot of arguments about whether that's still a relevant sort of range, with things as they are. So, there's some argument that perhaps that 2 to 3 should be moving to 2.5 to 3.5%. But, for the time being, the 2 to 3% has remained the target. Good morning, Sonia. Good to see you. Good to see you. Thank you for jumping on. All right, so let's have a look at. So this is what they typically do. They give you a sort of a summary on their decision. Then they give you an outlook, and then they sort of give you one of the key areas that they're looking at. So what is the outlook? Again, uncertainty, right? Because and they kind of go on to say why, right? But I would say most of the time it's uncertainty from their end, and they're looking at basically to see what the US tariffs do around the globe. And they also go on to say that it might still be inflationary, but they just don't know it yet, because it's kind of like we're going to go to 120% tariff, down to 30, down to 5, and then back to 60. So they basically want to see how that plans out. So what else they say? They say trade policy developments are nevertheless still expected to have an adverse effect on global economic activity. So, and that's what they're basically implying, that the tariffs will have an impact on the flow of goods and services. So then they go on to say that the labor market conditions remain a little tight, which means that the unemployment rate, they go on to say unemployment rate rose to 4.3%, but the average is 4.2, right? So what do they mean by that? It means that when the unemployment or labor market is quite tight, it means that the wages tend to rise. And when the wages rise, that means that you've got more disposable income, which then can create a little bit of inflation. So they're kind of looking at that and saying, all right, well, where's the truth in that, and what would be our next action? So that means that they're going to be looking at that quite closely. So they confirmed that by saying availability of labor is still a constraint for a range of employers, right? So, you don't have to look too far. You look at the construction space, you've got very tight labor market in terms of trades. I would say most of them have gone to Queensland, sunny weather, better conditions, and there's a lot of infrastructure happening there as well. So, which means that other states are kind of, lagging behind in that space. Mandip, good morning. Thank you for jumping on. Guys, by the way, if you've got any questions, let me know. If you've got any sort of topics you want to cover off on, let me know as well, because obviously this is all for you guys. And, I try to give you as much info about various things. So it's not just like sort of one linear sort of topic. So this is kind of a little bit different. And, try to give you an idea as to how we'll look at things, like what resources we use to give us an idea as to where things are moving. Okay. So then they go on to say that there's still uncertainty in our domestic economy. So again, inflation, they keep raising inflation as one of the main points, again, because that's one of the main targets that they're trying to maintain or contain, I should say. Then they go on to say that the businesses reported a weakness in demand is making it difficult to pass on cost increase to final prices. I don't know how about you, but the cup of coffee has gone up from $4.50 to about $6.50. It's crazy stuff. So I got my coffee here and I love it, but at the same time, are we going to be paying $20 a coffee in 2026? Who knows? Obviously there's some other impacts around coffee shortage and the issues in Brazil around growing coffee and everything like that. But still, the businesses are finding it harder to get customers in. You go to a restaurant, it's probably half full. There's people try to do like DIY or kind of stay at home and potentially not spend. So but they're flagging that as as an area that they want to look at, and reduced interest rates should help with that as well. So they go on to sort of to summarize, consumer growth is a little slower. You would know that, which leads to weaker labor market conditions. So obviously, if the businesses are not able to attract customers, then the employer or the business owners don't have as many staff on the floor, or whatever business it is. So, and that's what they're trying to change as well, if they can. But obviously, the interest rate here is what they're looking at and saying, look, reducing interest rates should open that up and make it a little bit easier. So then they kind of summarize to say, we've done so well. We reduced your cash rate by 75 basis points, which is 0.75% from the start of the year. Thank you very much. We're doing everything. So pat on the back for them. They then go on to say that, as always, the way that they finish these statements, they always say, hey, here's a rate cut, but by the way, we might change our mind in the future. This is kind of on the back of, I don't know if you remember, start of the pandemic. They basically said, look, we're going to freeze our cash rate for the next 3 to 4 years, right? And then, as we know, they went on this rampage of smashing out the interest rates for the next 12 to 14 months, whatever it was, 13 consecutive rate rises. So and now the tune is a little bit different. They're saying it's all about they remain cautious about the outlook, particularly given the heightened level of uncertainty about both aggregate demand and potential supply, right? So they're paying close attention to developments in the global economy and financial markets, trends in domestic demand, and the outlook for inflation and the labor market. So which means that, the tariffs and everything, they're still filtering that through, and they want to see the end impact, because that might have an impact on employment, cash rates. So if the employment is low, then that might be another reason for them to cut. If the employment is high, it'll mean that they'll have to potentially stay. If the the employment underemployment increases, then they might have to cut. So, but ultimately, they're saying their mandate is to deliver stability and full employment, which means that there's no indication of any further cuts at this stage. So that's the message that I got out of this, is that they're almost saying, look, we've gotten to our band of 2 to 3%. We're happy with that. Yes, there's some uncertainties around inflation from the tariffs that the US is kind of putting around the world. And, the business is struggling, but hopefully with the lower interest rates, that will bring that pain down and open up a little bit of more activity in the economy. This like I said, this is only like, a 1 minute to 2 minute read. It's not a big sort of content, but if you start reading and looking at different aspects of the message, right? And by the way, they could contradict themselves next report and say completely opposite things. So that's not uncommon. But if you start looking at between the lines and like, okay, well, what are they doing? What are they looking at? And then, for you guys, it's important to then translate that into the investments that you have, and sort of understand, like, if I'm about to go into a certain investment type, shares, property, bonds, whatever it might be, what's the impact of future interest rates activity, right? Am I going to be hindered by that? Like, we spoke about bonds, for example, a couple of months ago now. But, one of the indicators for bonds, which is a fixed interest part, is that if the interest rate falls, then if you're holding a bond currently, right, then the price of that bond goes up, because ultimately, if I'm in the market to buy a bond, which is a secure asset, most of the time with a dedicated interest rate, I want to buy it today before the rate cut, because that means that I'm going to be getting a slightly higher return on my capital. And then when the rate cut happens, then someone like me, who's again might be wanting to buy it, I might not go and buy what comes out at a lower rate. I might go and see what's available in the secondary market and pay maybe somewhere in between of what where the rates are now and where the rates were a week ago, right? So then, as an investor, if I held that bond before the rate cut happened, then the value of my capital has gone up, because all of a sudden, not only am I getting a high interest rate, I'm also getting a slight premium on my capital. So bonds work quite well during the period when the interest rates fall, because not only are you getting the income from them, you're also getting some capital return. Whereas on the opposite end, which we saw over the last, probably 2 years, when the interest rates were going up, is that the bond was losing that capital value, right? So it's only important if you don't hold the bond to maturity, because if you put in $100, you hold it to maturity, let's just say it's 5 years, you get your $100 back. But in between that period, if the interest rates are going up, then your bond might be worth $90. But if where we are now, the interest rate cuts, then your bond might be worth $105. So all of a sudden, you're making a 5% sort of gain on your capital. So anyway, I just wanted to share this with you guys, how we look at things. So we do read these as they come out. There's obviously media announcements and whatnot about this too. But typically it's that interest rate up or interest rate down or on hold, right? So, but I think it's important to have a look at this as well. Jump on the RBA website. It's all in there, typically like right at the top as soon as it comes out. So interesting read, takes a couple of minutes, but I think it's got a lot of value in it for you as well. So hopefully that helps. Something new potentially if you haven't done this before. And yeah, have a look at it in the future. That's all for me, guys. I'll see you all next week. See you later.
Thanks for watching another episode of Wealth Coffee Chat, folks. Make sure you like, subscribe, and turn on your notifications so you never miss a thing when we go live. Improve your portfolio and investing game, folks, with Wealth Coffee Chats live every morning at 8:10 each weekday. Make sure you join us. Previous episodes are also available wherever you get your podcasts, folks, as well as our other podcasts from the 6 Star team here at Positive